So welcome again. We have seen how to select prices, how to do a buy order and a sell order, and realize good profits by checking demand and supply concentration. So today, we want us to see long-term stocks to hold. These are called real wealth builders. In NSE, you don't just buy shares. You buy shares that will help you. And I said in the previous videos, if you have not seen them, you can check in the profile. That is on my account, or you can check on my YouTube channel. I have done full videos including live trainings. I've said before there are only two ways of making money at NSE. One of them is buying low, sell high. That is capital gains. That's what most people know. The other way is by leaving the shares there, let them stay there. You start earning through dividends. As and when companies announce dividend, we'll see all those dividend stocks. So those are two major ways. The other ways you can make money could be either taking loan, using shares as collateral, and there are also other few areas that NSE are trying to innovate around, but those are two major ways. Selling at a high price, make profit, or you hold shares, you just get dividend as and when the companies announce. I'm doing a beginner series that covers all these. So then what does long term mean? Long term means holding a period more than 5 years, 5 to 10 years or even more. Usually when you buy shares, you don't declare I'm buying today and sell tomorrow. That's short-term trading, and you may end up losing. The best strategy is where you buy without a defined period. You say, I'm just buying. If I'm chasing prices, I'll sell when I make profit. Or you just buy, hold them there. Shares you can hold for eternity. Then you pass over to your generation. I've done full video on wealth creation using shares and even generational wealth. Where you buy shares, you can do a will where you specify who gets what, or your beneficiaries, when you're not there, they can get letters of administration, then they agree how they will share. They go to court, court gives its pronunciation. Those documents are taken to the broker to initiate share transfer from your account to your beneficiaries. So shares can never be lost. So when you hold for eternity, it means if you're holding dividend stocks like you buy today and you keep on accumulating more, every year when company announces those dividends, you are paid without selling your shares. It's like free money. When the company makes profit, you are paid. Remember, when you buy shares, you become a shareholder. You become a part owner of that company. When it makes profit, then you're entitled to that share of profit. Most of the companies, as you see, they announce. So focus on how the business performs. So you focus on how the business is performing, whether it's making profits, they have innovations because of growth, not daily share price. If you are concentrating on share price, then you are chasing capital gains. And remember, when you buy and sell, there are commissions on both sides. So you always need to factor that if you are chasing share price. You also ignore, in the long term, you ignore short-term market noise and speculation. Like I've seen their videos circulating on TikTok and also YouTube, but apparently those are people who don't know how the market works. Who are saying the market will crash, foreigners are exiting. I'm yet to see the foreigners exiting. I'll be doing a video next to show you how you can tell foreigners are exiting. And it is very simple. The dollar will always tell you whether foreigners are exiting, even euro. When they exit, remember they're withdrawing money from Kenya, moving outside. There will be demand for dollar, so that means exchange rate also increases. So that you can always tell. There is no foreigners moving out of NSE. I've not seen any. What they usually do, they rebalance their portfolio. They sell the stocks which they have bought high, they have made profit, buy stocks which have depreciated in price, or even buy the same stock at a lower price. I've talked about GTD, where you can buy stocks at lower price, then you sell at high price. That's what they do, most of foreigners. And most of people who buy from them are our local funds and pensions administrators, because most of these pensions and also funds, they invest in NSE shares. So they have to buy shares. They also have to sell when they make profit. Same as foreigners. There is nobody who have left the market. IMF, they have no effect on NSE. I think you need to filter out this market noise. As a long-term investor, don't even listen to them. Just go give them a view. You can just put the video, leave it there, let it make noise to the head, give a like. You can even comment, because that's what they are looking for. These are not people who understand the market the way it works. And nobody have left the market. I'll show you in the next one how you can tell. From online portal, you can tell. From the NSE reports, you can tell. The way the dollar is performing, you can tell. But nothing has happened. Between December and now, it is a slow market. There have not been a high demand because people are concentrating on holidays and also back to school. Once that is done, you see the market rebound, and companies are starting to announce results from February, March, April. So I'm not sure whether these same people you tell you foreigners are coming back. Nothing like that. So also they allow time and compounding to grow value. That is the most important. Time. Give shares time. When you buy today, don't expect the price to go up the same day. You'll actually see a negative in your portfolio, but it doesn't mean you have lost. Remember, as I've said in the previous videos, average cost includes costs you have incurred to buy shares. It is price, cost. Market value doesn't have. So if you have bought today, the price is the same. But remember, the buying price also includes cost. It will be higher than the current price. You see negative. Don't panic. It's not a loss. You have not sold. Give time. Prices will move up above your average cost. That time you break even. But if it is a share that is giving you dividend, don't even look at how it is performing. You concentrate on the dividends. When they come, buy more of that share or a different share and target lower prices to lower your average cost or maintain your average cost down. So the strategy usually is when you buy shares, they declare dividend, you get dividend. That time prices may have gone down below your average cost, your average price. You can buy more. If they have not gone below, they've gone up. Look for another dividend stock whose price is below your average cost. If you already hold shares. If you don't have shares, I've said in the previous video, that's why now you check price movement. You buy shares which are at a low price, or if you're targeting a dividend stock, target lower prices. So long-term investing means owning a strong business through different market cycles. The market have cycles and they keep on changing. You have elections time, when there are new regulations, holidays, foreigners exiting, local funds offloading their positions, them coming back. All those cycles are there and they follow each other. You can always tell when a certain market cycle is active. So short-term price movement are driven by emotions and news. Like the people who are saying market will crash, they're just hyping the market so that you come and start selling. You push prices down. So don't be tempted. Also news, negative news affecting companies or positive news affecting company. You see price fluctuations. But long-term value comes from consistent business growth. So why time is your biggest advantage? Market will fluctuate in short term. If you buy shares today, tomorrow they will be negative. Do you panic and sell? If you give it a month or two, prices may stabilize at the same price you bought. Do you still sell their costs? But if you have to wait 1, 2, 3, 4, 5 years, price will fluctuate even above. Look at what happened in 2023, 2024. Prices went down. Those people who panicked, they sold at a loss. Those who didn't panic, 2025, prices have shot up. They may have made double or triple. So the longer you stay invested in quality companies, and here it's quality companies, because there are companies, as you see at the end, which I wouldn't advise you buy, and if you buy, sell when in profit. So the longer you stay in quality companies, the more powerful compounding becomes, because you're receiving dividend. Don't eat, buy more shares. Remember, this is free money buying free dividend. Then that dividend, when it comes, it's also free. You add it back, so you start compounding. For those who know compounding, or if you have ever done pension, you know how it works. If you have done circle, you know how it works. The total you buy, it's added back to your total shares. That new total earns a dividend. You come and add more. You keep on growing your dividend. I've done a full video on how to grow wealth at NSE. I don't want to go into details, but I'll try in my beginner series to now break all these. So what are characteristics of a good long-term stock? One, consistent revenue and profitability. Company must be generating revenue from their core business. Then when they factor out their cost, they should be profitable, because this profit is what they pay you. Then strong balance sheet, which means what? The shareholder equity added to liabilities is either equal to assets. That means if assets were to be sold, that company can pay its liability and shareholders are left with something, not the other way around, where liabilities are more than assets plus shareholder equity. So if you find a company, when you look at results and you find in balance sheet, the shareholder equity is on asset side, then that's a company you may need to rethink again, or even forgo if it has never been paying dividend. Why? Because if that company was to be liquidated, remember, assets are the ones to be sold to pay out liabilities. If liabilities are more, who then forced to pay is the shareholders, meaning your shares are sold to pay out those debts. Remember, the company is offloading everything, even at NSE. It's being bought out. So in such a case, you need to buy a company where shareholder equity plus liability is equal to assets. So shareholder equity plus liability, so that if assets were to be sold, even you as the shareholders, you get back your money. Then cash flow, free cash flow. I've talked about this in the previous videos. It's the most very important thing. You need to check dividends, previous dividend was paid from where? Was it paid from carry forward for the free cash in the previous year, or it is within the same year's revenue and profit? If it is within the same year, it means this is a company that is paying out dividend and retaining cash, hard cash. So you also need to check cash flow statement to see whether company have been paying dividend out of debts, or either it's paying from rollover from previous year, because then it tells about the revenue and profitability. Then stable or growing dividend. A company that is giving a dividend throughout, and that dividend has not been declining. If it is on the declining side, you need to be very careful. At one point, they might stop paying that dividend. You need a company that's also growing in terms of dividend. Dividend in two ways. I've said this before: cash or bonus shares. So if a company is giving cash, then you are receiving cash in your bank. If it is a dividend in form of bonus shares, they are giving you additional shares for free, which you can sell. But why sell if you can still gain from these shares? And there are those which give both. They give cash and also free shares. And the reason why they give free shares is so that part of the profit is left within the company for company operations and growth. Then a company that have high trading liquidity, that is, there is always buy and sell orders. If you go to market depth, you can see there is enough shares to buy and enough shares to sell. If a company lacks one of these, then it tells you if you are to buy and there is no supply, then selling will be a problem. Like what have been happening with Uchumi previously, blocking one side, you are not able to buy. So then how will you sell? Then when price goes up, you're not able to sell, price fluctuates. It's like you're just playing with the prices. And remember what I said, those price movement, even if they are announced by a NSE a million times, even using the loudest speaker, that does not help you. Price movement does not help you as an investor. It only helps you when you sell. You buy low, when prices go up, you sell. That's the time you are gaining. But these other noise in the market, NSE, they are just creating their name. Brokers are just creating name for their own valuations. But it doesn't help you as a client if you don't sell when you make profit. So when you see prices being announced, they have moved up. If you hold those shares and you're not selling, you're not making anything. You're just singing the same song. There are people who are selling at that point. Those are the ones who are gaining. But you don't have to sell a good dividend stock. Because when you sell a good dividend stock at high price, when will you buy? It's not guaranteed market will go down. Only sell if you are within a good profit that you see this is good. Instead of me taking dividends, let me sell and be willing to buy back now at a higher price if that's where the market is. So that's a decision you need to make when you are selling. If you sell, remember you are removing yourself as a shareholder. You are not entitled to further dividends. If you want to continue accumulating dividend and you have sold, you have to accept one fact: buying at the current price, which could be higher than your average price initially. So you need always to check before you sell what you have portfolio. If you bought shares at a cheap price, don't be in a hurry to sell if that share is giving you good dividend. Accumulate dividend. Immediately you sell, remember you can't buy back at the same price. You'll be forced to buy at a higher price. Again, average cost. So these companies are resilient and can survive economic downturns like 2023, 2024. Any company that gave dividend that time, it survived its worst. It's a company that is performing. They don't rely on hype and speculation to create value in the market. So then why dividend matter in long-term investing? First of all, they provide real cash returns. Your money is already invested. You get actual cash paid directly to you. And you can tell by number of shares you have times dividend amount. Then it helps you reduce dependence on selling shares for profit. Because immediately you sell your shares, buying back, you have to wait for prices to go down, or you be willing to buy at the current high prices. You also continue even when prices stagnate. When prices either don't go up or when they go down or prices are going up, dividends still come without you selling. Then they enable investment and compounding. Investment is where you come and buy back shares with the same dividend. That dividend you have bought gives you another dividend. Come back, buy more shares. It's like you're using the same dividend to grow your portfolio. But remember, dividend calculates the total number of shares. So the shares you are adding back with the dividend that you have received, they keep on compounding your investment. And that's how you grow your wealth. So dividend turns shares into an income generating asset. Remember, shares are not like land where land is not built. There are no returns. It's not like other investments where you have to withdraw. Here it's money being sent directly to you without selling anything, without doing anything. You just bought, you wait, money comes. And reward investors for patience and long-term ownership. Remember, the more you hold shares, the better. And there is no minimum number of shares you can hold. You can hold all dividend stock. If you want to even hold everything in NSE, it's not about the money you own. But remember, there are two categories in NSE: dividend stocks and capital gains. There is no other category. Forget about the other categories you have had on social media, even in trainings. In my previous trainings, it was to help you understand there is theory and there is practicals. In NSE, practicals is different. You only have to categorize dividend or capital gains, or a share is both. Share is either giving you dividend or price is moving up, you sell at a profit, nothing else. So let's come to liquidity. Liquidity is a critical factor that is always ignored by people when buying shares and selling. Liquidity is your ability to buy and sell share easily. That's what liquidity is. Can I easily buy this share? That is, are there people selling? Can I easily sell this share? Are people buying? And that you can tell from market depth. On the app, you just click on the watch list, you click on the share, that screen that is split into blue and red. Offer, bid and ask. On the portal, it is already there. If it's not there, on the bottom right, there is a plus sign. Click on it, add market depth. It has bid and offer. That can tell whether share is liquid. If one side is empty, it means you can only do one side, and those people are struggling. That means it's not easy either to buy or sell. Also, number of shares. If they are very minimal, like you find it's only 100 shares which are available on buy or sell, then it means that share is very hard to buy or sell. It is liquid. Then ensures gains can be realized. That is, you can easily buy or sell in a profit. It also reduces risk of being trapped in a stock, like what has been happening in Uchumi, where you buy, you are not able to sell. And if you have to sell, you have to sell at a loss. In some cases, you find a stock maybe suspended and signs are always there. You can see reduced sales or buys. That means if you buy that stock, you'll be trapped forever, like Mumias, Transcentury. Those are stocks which trapped people. Where they bought, it was suspended, it can't trade. So if you can't trade, you can't get money back. Remember, these are shares that have been suspended. Company, even if it is operating, it can't declare dividend. Then liquidity also leads to more reliable pricing, because if you're able to buy and sell quickly, it means prices are fluctuating. If you are to look at the graph on the market depth or next to market depth on the online portal, you can tell some stocks. There are stocks you can buy even in the morning at a lower price and sell in the evening at a high price, depending on price movement and price volatility. So liquidity determines whether profits are real or on paper. Why? Profits are only real if you're able to do the actual sell. On paper means you're just moving with prices. You're not selling when prices go up, they go down. You're in loss, it goes up, you're in profit. Like what has been happening with Uchumi, that game that was played that holiday. Price goes up, you're not able to sell. Yes, you're reporting profit, but have you gained it in your account? Have you sold and withdrawn that money? No. It's only on your account, on paper. And that's what most people are doing these days. You invest, market goes up, and as you're singing the song, market is improving, you're also singing the same song, but you're not selling. That's not helping you. That profit is left there in your account. Remember, prices move up. At the highest, you have the profit, starts to go down, profit reduces to negative, to losses. And one time you'll be telling people, I used to make money, but you never sold. So for liquidity, liquid stocks helps you realize that real profit. When price goes up, you can easily sell and get back your money in profit. So liquidity matters a lot. It helps you know whether you get real profits or your profit will just be in paper. Remember, it's your money you have committed. It will just be there. And at the end of it, you might end up losing, selling at a loss. So a stock without buyers can not be exited. And that means paper profit, regardless of price movements. Look at Uchumi again. At one point, a month or two, it kept that play. People buy, push the prices up, reaches to the top, nobody is able to sell, you broke. Sell side, they are not willing to sell that price. When they want to sell, now people don't want to buy because it's high price. You again broke, price goes down. And some of people right now could be in a losses. Huh? I think right now Uchumi could have stabilized, and if you're in a profit, just exit that stock. If you are holding money that is not helping you, buy a stock that you can project some gains through dividends. Huh? If you are buying stocks that don't give dividend, you must sell. That's the rule of the thumb. Huh? Then there are these stocks people usually call boring stocks. Huh? They're usually held by retirees. Huh? But these are the wealth builders. Why? They have low volatility. Price don't swing. And if it moves with a very huge margin. If you wanted to sell, you can sell in profit. They have stable earnings. Dividends are high. Reliable dividends every year they are giving, and strong long-term performance. If you are holding it long-term, you find the other share that you bought maybe at 100, 200, 300, 400, it goes to 1,000. But as long as you're not selling, you are not making capital gains. Huh? So exciting stocks, the one that people like, they attract attention. And that attention plays with the price. But you find these are stocks that are not performing in terms of company performance. They don't have profits, and they are not giving dividend. If you're not selling, the price goes up, it doesn't help you. But boring businesses, they generate returns and survive market cycles. You find even when there is a crash in the market, prices don't fluctuate a lot. Actually, those are left. They are the ones which support the market. Huh? So what long-term investing is not, one, it's not chasing price spikes. That's not long-term. Huh? Following social media, actually that ignore. Just give people likes and views and even comment, but don't follow what they are doing. Huh? Constantly buying and selling. When you're buying and selling, you're not investing. You are trading. There are costs to incur, which may eat into your returns. Only sell when you make profits. Huh? If you're into trading, there is a strategy which I'll be coming in the next few videos, how you can buy low and sell high, but factor out costs. If you're investing long term, your work is to concentrate on reducing average costs and increasing number of shares to increase your returns both in dividend and also in capital gains in future. So most losses occurs when investors confuse speculation or trading with investing. Trading and speculation are not investing. Investing is where you buy and forget, you relax. Trading is where you buy, then you are starting to look, when do I sell? Those two are different. Huh? So let's come to long-term stocks to hold. I've separated into three categories. Those that give high dividends over 3 shillings per share, those that give below that, and those that don't give. So some of the stocks to hold long term, if you hold these, unless there is a justifiable price movement, a justifiable profit, don't sell. I've seen people asking on social media and also on my DMs, brokers are recommending a sell position. That's a broker. It doesn't know your portfolio. They have not seen your portfolio, how it performs. Brokers will just give it. And unfortunately, I will be coming to all this. Hopefully, I don't get into trouble with some people. You need to verify that information. Some of research I've seen online is actually copied from some of online research sites, stockanalysis.com, TradeView, and there are many which are becoming, when I'm doing training for international stocks, which I'm starting soon, hopefully this week, you see some of these sites where they give recommendations. People are copying there. And I would like you compare the list of recommendations for one stock from January last year to this year. There are stocks which have been recommended, buy, then sell. Then eventually, when stock prices are going up, you buy. So when did you sell at a high? Where is somebody telling you to buy at lower price? When it goes up a bit, they tell you sell. When it goes up, they're telling you to buy again. Then eventually they will tell you to sell. Remember when you sold in between, you lost the average price that you bought lower. So you are buying back again at a higher price. These are some of the things you really need to read, but for guide, not as the final decision. There is always a contradicting information, but that's them. I'll be coming to that because I want to clean up the industry so that we trade with information that is justifiable and that is from the market. Deal information. Huh? So let's start with the first one, BAT. It gave a dividend of 55 shillings per share. This is one of the stable stocks that I'm calling boring stock. Because if you're buying BAT, don't expect the price to fluctuate. You'll be in a shock. It will even go down with a very huge price difference of even 20. But when it goes up, it might go up even with a huge difference of 50. It's not a stock for speculation. It's a stock for holding long term. Only sell when prices go up. And these are stock you can use GTD if you are targeting price. I'm doing that video where you can buy at a lower price. Then use the same GTD, place a sell order at a very high price. You make that when it executes. And those ordered GTD, you just leave them and forget. Until that, you just be coming and checking whether it executed. So BAT is a boring stock. Don't expect price fluctuation. It's a dividend stock. Then there is Standard Chartered. Again, a boring stock because price is high. It doesn't fluctuate. Don't even expect the price to fluctuate. You saw even when they had a case with their staff member for pension, price didn't go down that huge. And again, it remains stable. These are stable stock. Dividend of 45 shillings. Stanbic Holding, the same thing, 22 shillings and 70 cents. Jubilee Insurance, Jubilee Holdings, 13.50. And the reason why Jubilee is giving a very good dividend, it's backed up by an international company. It's a global company. They also have investment wing, fund management. They also have insurance, and it is quality insurance. They don't deal. I don't think they deal with those risky products where you get a lot of claims. And claims here, I mean, they don't deal with public vehicles because those ones, any company dealing with that claims it into their profits. Mostly they deal with high-end. If you look at even their premium can tell. In terms of medical, they deal with corporates. So you expect these are companies dealing with profitable business. That's why they give good dividend. But their price is high. Again, very stable. Capcholwa, were it not for the bonus they gave and also the dividend they gave, price would be very stable. But they gave a dividend, price went down with a small margin. Then bonus, because it is additional shares which are not supposed to change. Market capitation. Then it meant price had to go down, because these are free shares that had been floated. So again, a very stable stock for long term, and these are most expensive stocks in the market. Come to BOC. BOC, again, a very good stable stock. Umeme, the reason why it is here, it's because in 2025 it gave dividend, but it's not a stock to hold. Umeme, just strike it off because they will not be giving dividend again. Umeme will not be giving dividend. I'll be covering why. They are contracted with Uganda government. So the money they were reimbursed is what they give as a dividend. That's why it was able to go to 8 shillings. But if you have it in your stock, in your portfolio, think of how you can exit when it is profitable. If you don't have, don't buy. Umeme is not a stock to hold. Then there is EABL, a very good dividend, 8 bob in 2025. Good to hold long term. Again, boring stock. Price doesn't fluctuate. Kakuzi, the same thing, 8 bob. Price doesn't fluctuate. So those are some of the stable stocks. Strike Umeme, the rest are very stable. We come to DTB. We come to DTB Kenya. Again, very good dividend. NCBA, very good dividend. Baburi, very good dividend. Williamson Tea, very good dividend. They also gave bonus. So if you are to add bonus, then that dividend will go up. And Williamson Tea price have gone down. And right now it's accessible to everyone. I think it's around 140. If you want to buy, it is the right time. When it starts to shoot up, it will go back to where it was. Remember, the price went down because of what I said, together with Kapchorwa, bonus shares. Prices had to readjust downward to maintain the same market capitation in NSE. So Williamson Tea, a good stock to buy right now. If you are looking to buy shares, this is a stock to buy. Dividend will still be maintained. Hopefully even next year they might give a bonus. If they don't give, price expect to fluctuate upwards. But again, all these stocks, some of these prices are above 100, some are above 80, like NCBA. That's why they are stable stocks, expensive, but they don't fluctuate. Give good returns as you sit down and wait. They are very good for retirees, but when price moves for some of these stocks, it moves with a very huge margin. Then we have Equity Bank, very stable. Like right now, it's 69. Previously, they have done a split. When they were around 69, it went back to around 30 something. And it started again to appreciate. I think when they did, it went, was it around 13 or something? And right now, it has gone back. So for people who have been holding this Equity Bank, when it does a split is where number of shares are multiplied, but price is divided by the same ratio. They did a split, I think, of 3, where the price was divided by 3, shares were multiplied by 3. So if you have 1,000, you have 3,000. When the price goes up, remember you are in a profit. You can decide to sell, but why sell a company that's also doing a split? It can do another one, multiply that share, and that's how you grow without even adding more money. They have a very good dividend, 4.25, a very good stable stock, but target to buy at lower prices. If prices are going down, don't be in a rush. KCB Bank, the same thing, very good dividend. Even if prices are high, if prices are going down, you wait for prices. When they start to go up, you put at a lower price. I've shown you how to do GTD, but I will also come and show you now how to target these low prices. INM Group, IMH, very good dividend, good prices. It's a stable. Some of these are banks, very stable. Crown Paint, very good dividend. So these are some of long-term stocks, but remove umeme. So that is the clean stock list for long-term holding. I've removed umeme because it's not a stock you should be buying right now. It was there just to show you the dividend they gave. But now you have BAT, Stanchart, Stanbic, Jubilee, Kapchorwa, BOC, EABR, Kakuzi, DTB, NCBA, Baburi, Williamson, Equity, KCB, INM, Crown Paints. Those are long-term stocks to hold. If you have them, don't sell. Getting these shares at lower prices will be a hassle. Don't even imagine. If you have made profits, if you are selling at a profit, you have to make one decision. You are selling, and when you buy back, you buy at a higher price. So that is the pain of selling. Unless you are selling and withdraw that money or take it to another stock. So these are stocks to hold. If you have them, just keep on holding. These are actually add more so that you beef up your dividend. And you can always target, like BAT, if you have 1,000 shares, that's 55,000. You can move now to Stanchart, build it to 1,000, that's 45,000 every year. Stanbic again, 22,000. Jubilee, 13,000. Kapchorwa, 12,000. But these two you can beef up maybe to 2,000 so that you get same returns. The others, again, that's how you build your portfolio. Take 2 shares, push them to a certain figure. BAT, push it to 10,000. That's it. Move to another stock, push it to 10,000. That way, you are not chasing prices, but you are building your investment. Don't try to chase prices. Take one stock, build it at lower prices, watch another one which is lower, build like that. But if you have a lot of money, you can distribute. Because now these dividends are also staggered across. You don't want to just buy one stock. If it is affected, then your whole portfolio suffers. I'll be coming to that video on portfolio building. Right now, we have run a lot both on live and also offline. Now I'll be coming to the next video where now we'll be building portfolios. Now we have long-term stocks to hold. For stocks, these are regular dividends which give below 3 shillings. Again, if you hold them, it's just a decision. These ones is a decision to make. Do you want to take capital gains or do you want to wait for dividend? BKG 2.68, Co-op 2 bob, and this is interim. They'll be giving another one. So for Co-op, it might be higher. Kabasid 2 bob, Total 1.92, Absa 1.75, Safaricom 1.2, Kenya Power 1 shilling, East Africa Potrad 1 bob, Liberty, Kenya 1 shilling. It's the second company that gives dividend in terms of companies that are in insurance. Then we have Kengen 0.9, Rap Trust 0.82, Kai General 0.6, TPS East Africa 0.35, Centum 0.32, NSE 0.32, Kenya Re, one of penny stock that give dividend 0.15, CIC, again another cheap stock, penny stock 0.12. So these are the only 2 penny stocks, but the others, which like Kengen, it usually fluctuates within penny stocks and also regular dividends. So if you have these stocks, you only need to make a decision. Do I wait for the dividend and keep on accumulating, or do I take profit? Because if the share price have moved up way high, it's not always good to wait for dividend for some of these. You can sell, take profit, buy now a cheap one, wait for the prices to go up, sell again, come and buy back. So these are the stocks that you can play with prices. These ones, don't try. Prices are very stable. Even if they move, it's not that huge. You won't even notice. But these ones, you can always tell when prices are fluctuating. But again, if you have them and you are investing, you are not trading, hold them. This small dividend, you only need to beef up the shares to huge numbers. Like for Co-op with 20,000 shares, you already have 20,000. Difference with BAT is the number of shares, but again, prices are not the same. So for this one, if you have low income, you can start with this one, buy gradually. Even these ones you can buy, because these days you can buy 1 share. So you come to that video for portfolio building. You see how you can build portfolio without stress. But these are stocks to hold. These ones, don't think of selling if you have very good dividends. These ones, if profit is more than dividend, you can always sell, then buy back at small lower prices if you bought at high price. However, if you bought at lower price, that is your average cost is low. Don't try to sell. The same thing I said here. If you sell, remember, you have to be willing to buy the current prevailing prices. Then we come to stocks that you don't need in your portfolio. If they are there, you're just parking your money. Non-dividend paying stocks, they are for pure speculation, and you need to sell whenever you are in profit. They are not for health building. They don't build anything. Britam, KQ, HFCK, Sasini, I think they might be giving dividend, but I've not seen them give for quite some time. Simia, Nation Media, NVB, Yuga, TCL was suspended, Sunram. So if you have TCL, you just wait for it to be unsuspended. When price goes up, sell. The Sunram, Limuru, T, Scan, Amka, RKR, IGAD, Home Africa, Uchumi, Standard Group, Cable was also suspended. SKR just listed the other day, doesn't give dividend. price stagnates, it's even, I think it could also be going down. Orchard, Express Kenya, Frame Tree, Liquidity. Those are pure speculation. When price goes above your average cost and you have profit, just sell. If you don't sell, this stock is not helping you. And don't be led by anyone. Prices will keep on fluctuating up and down. You are just parking money there. How is it helping you? It's like you taking money, put in your wardrobe, cruise, then it's just there. If you don't use it, it's not helping you. The same thing. If you're not selling these shares when they're in profit, you're just parking money there. So if you have these stocks, when your portfolio turns in green and it's good profit, just sell them off. And start thinking of how now you can buy these stocks. You can start with this if you are just a beginner, or even this. I have shares, one share of BAT, and it's doing well. If I had 10 shares right now, I would be talking about dividend and also capital gains when I sell. Some of these I already have. I usually buy dividend stocks. These ones for long term, and these ones for long term. And when I am in profit, I always take some profit, but not withdraw, but also to return back. These ones I hardly buy, even if they are making money. Uchumi, you saw what happened. You buy, you can't sell. And it's not about a company name, it's all about your money. So you are not investing to help a company, you are investing to make money. So in the next video, we'll see how now you can start investing on each. I'm starting with BAT. And also then the other stock is WTK, because those are stocks which you can start with. And I'll be doing every day at least 2 or 3 stocks, so that you know how you can get at a lower price, how that company helps you, what they do, so that you understand very well what you are getting into. I'm also doing beginner series where I'm explaining the whole process of buying shares so that you understand, and not just local shares, international shares, also money market fund and other products of investment. Because what I've realized on social media, everybody just comes and gives what they know. But you find some people don't understand even the information that they are giving out. So you need to be worried about information that is accurate. Because I've seen a video which is not that good. It's only that I don't comment on other people's video, where somebody is saying market will crash. Crash going where? Government cannot even allow that to happen to start with. The NSE cannot allow that. They'll just suspend everything. You have seen them suspending a stock when prices are just fluctuating. But people just put information out there, come and give it out, and we will believe it. The market NSE cannot crash. NSE cannot crash. NSE have carried so many products for capital markets. So how will it crash? I wish it's somebody I can talk to. I'll tell them openly, you are misleading people and you don't sell because that information is out there. Those are people who are just looking for likes, followers, and subscribers. I better not have subscribers and followers, but give right information. That's why I also do free trainings. I don't charge, so that you have this information for free. If I charge, few people will come. Then I'm locking so much potential out there which can be helped by these videos. I don't charge. I don't sell videos. Only ebooks when I start making them, and because of the cost of making those ebooks. Remember, these videos I'm doing for free, so why should I charge? Webinars, I'm only using time. So basically, whatever you see out there, digest, understand it, do more research, and see whether that person is helping you. There are people who will make you lose money. They come and tell you market will crash, we want to sell. There are people who are willing to buy shares at lower price. When they see there's so much supply, I'll be doing a video for each stock so that you know how each stock behave. There are people who just watch and see. There are people who are willing to sell, they withhold shares. You push prices down, they buy at a lower price. Then price goes up, they sell at a profit. That time when price is going up, it is you, the same person who sold at a lower price, who want to buy back. You buy at a higher price, you are going at a loss. And I'm on all social media, so you can always check a link in the description and also on the bio. And more videos on my YouTube channel where you can get detailed. And I also do free trainings Wednesdays, Fridays, sometimes weekends, and any other time of the day when I find time. And I'm trying now to find how I can train even other products for free. So with that, let's meet in the next one. And this is my WhatsApp number, just in case you want to reach out. That's my WhatsApp number if you have anything to ask for free. Thank you. Let's meet in the next one.